What happens when the physical market sends a signal that the paper market can no longer control? What happens when buyers are willing to pay significantly above the quoted global price just to secure real metal? Today, we are looking at a powerful development in the silver market, China paying a $9 premium for physical silver. This is not noise. This is not speculation. This is a structural signal that demands serious attention from investors, institutions, and policymakers alike. Let's break down what this really means, professionally, factually, and without exaggeration. When a major buyer is willing to pay a $9 premium above the global spot price for silver, the first question serious market participants should ask is simple. What is the market signaling that the headline price is not? In commodity markets, premiums exist for practical reasons: transportation, insurance, local taxes, and temporary imbalances. But those premiums are usually measured in cents, not in multi-dollar spreads. A move of this magnitude is not routine friction. It reflects stress inside the physical supply chain. The global silver price is largely shaped by futures trading, where contracts represent promises rather than immediate exchange of metal. Most of these contracts are never settled with physical delivery. They are rolled over, offset, or cash settled. This structure provides liquidity and efficiency, but it also means that the quoted spot price is heavily influenced by financial flows, leverage, and short-term positioning. When physical buyers step in and pay significantly above that price, they are effectively voting with capital that the benchmark does not represent current on-the-ground conditions. Think about what a premium really measures. It is the price of immediacy. It reflects how much someone is willing to pay to eliminate waiting time, counterparty risk, and uncertainty. A $9 premium suggests that buyers value certainty of supply more than adherence to the futures quote. That is a powerful signal. It implies that access to real, deliverable metal is tighter than the paper market implies. From a financial perspective, this type of divergence often emerges when inventories are constrained or when industrial users fear disruption. Physical markets operate on logistics, refining capacity, warehouse availability, and shipment timing. If any part of that chain tightens, premiums rise. Unlike speculative spikes in futures markets, physical premiums are typically grounded in real transactions and settlement. Investors should understand that such premiums do not appear randomly. They emerge when there is urgency, either to secure production inputs, to hedge against supply risk, or to protect capital in tangible form. When that urgency becomes visible through price spreads of this size, it challenges the assumption that the global spot price fully reflects equilibrium. This does not automatically mean the broader market is collapsing, but it does indicate friction. And in financial markets, friction is often the earliest measurable sign that underlying supply-demand balances are shifting in a meaningful way. If the global silver price is supposed to represent the balance between supply and demand, what does it mean when real buyers consistently pay far above it? This is where the structural difference between paper markets and physical markets becomes critical. Futures exchanges are designed to provide liquidity, price transparency, and hedging tools for producers and consumers. They are efficient financial mechanisms. But efficiency does not automatically guarantee that the quoted price always reflects immediate physical tightness. In the futures market, silver contracts are traded in massive volumes relative to the amount of metal that actually changes hands physically. A single ounce of silver can be represented multiple times through leveraged contracts. Most of these positions are never intended for delivery. They are speculative trades, hedges, or short-term tactical allocations. When contracts are closed or rolled forward, the transaction is settled financially, not with the movement of bullion. This creates deep liquidity, but it also means that price discovery is heavily influenced by capital flows, margin positioning, interest rates, and macro sentiment. Here's the key issue. The futures price assumes that delivery is possible if demanded, even though only a small fraction of participants ever request it. As long as confidence in that system remains intact, the benchmark functions smoothly. However, when physical buyers step outside the exchange mechanism and pay materially higher prices in the open market, they reveal that immediate supply may not be as abundant as the paper market suggests. A sustained divergence between the futures price and the physical clearing price raises a legitimate financial question about whether leverage is overshadowing underlying scarcity. If financial contracts expand faster than physical inventories, price discovery can become distorted. It does not imply manipulation by default. It reflects structural characteristics of derivative markets where not every contract is backed one-to-one by deliverable inventory. For institutional investors, this gap matters because it affects risk assessment. If the benchmark price understates physical tightness, hedging strategies may not perform as expected under stress conditions. Industrial users relying solely on futures pricing may face higher acquisition costs in real-world transactions. Portfolio managers using paper exposure as a proxy for physical scarcity may underestimate volatility potential. The integrity of a pricing system depends on alignment between synthetic supply and physical availability. When that alignment weakens, even temporarily, it challenges the credibility of the benchmark. Markets can tolerate small discrepancies, but persistent and wide spreads suggest that financial pricing mechanisms may be lagging real-world conditions rather than accurately leading them. Why does it matter that China is the one paying this premium? Because in the silver market, China is not a marginal participant. It is a central pillar of global demand. When a country with significant industrial scale steps into the physical market and accepts a materially higher price, that action carries far more weight than isolated retail buying or short-term speculative activity. China's demand for silver is deeply tied to industrial production. Silver is a critical component in solar photovoltaic cells, electronics, semiconductors, electric vehicles, and advanced manufacturing systems. These are not optional sectors. They are strategic industries embedded in long-term national development plans and global supply chains. When factories require silver to maintain output, purchasing decisions are driven by operational necessity, not short-term price sensitivity. If production timelines are at risk, securing supply becomes more important than negotiating small pricing advantages. That is what makes a $9 premium meaningful. It suggests that buyers within China may be prioritizing continuity of supply over adherence to global benchmark pricing. In financial terms, this reflects inelastic demand in the short run. Industrial users cannot easily substitute silver in many high-performance applications without redesigning products or sacrificing efficiency. When demand is structurally embedded in production processes, price responsiveness declines, especially during tight supply conditions. Another important dimension is scale. China's consumption volumes are large enough to influence global trade flows. If domestic inventories tighten or imports become more competitive despite elevated premiums, that can shift supply from other regions. Commodity markets are interconnected. When one major hub bids aggressively for physical metal, it can reduce availability elsewhere, potentially widening premiums in other regions as well. Investors should also consider policy alignment. China has made substantial investments in renewable energy infrastructure and advanced technology manufacturing. Silver demand tied to solar expansion alone represents a significant structural driver. When industrial policy supports long-term capacity growth, underlying metal demand can remain strong even during periods of economic volatility. From a financial analysis perspective, the key takeaway is that this premium may reflect genuine industrial demand pressure rather than speculative accumulation. That distinction matters. Speculative surges can reverse quickly when sentiment shifts. Industrial consumption tied to production targets tends to persist as long as output remains stable or growing. When a major industrial economy demonstrates willingness to secure supply at higher prices, it sends a clear signal to the global market. Access to physical silver is strategically important. That signal deserves close monitoring, particularly if premium levels remain elevated over time. In commodity markets, inventory is the silent stabilizer. It absorbs shocks, smooths volatility, and provides confidence that supply is available when needed. But what happens when that buffer starts to thin? Premiums begin to rise, and they rise quickly. A $9 premium for physical silver is not just a pricing anomaly. It can be a reflection of tightening inventory conditions that are no longer sufficient to cushion demand. Exchange inventories, particularly those classified as deliverable, play a crucial role in market psychology. They represent metal that can theoretically satisfy futures delivery requests. When those inventories decline, even if gradually, the perception of available supply changes. Markets are forward-looking. If participants see a downward trend in stock levels while industrial demand remains steady or rising, the willingness to pay more for immediate access increases. Inventory tightness does not require a complete shortage to influence pricing. It only requires the perception that available supply is becoming less flexible. In physical markets, flexibility is everything. Refiners need steady input, manufacturers need predictable shipments, and traders need confidence in settlement. When available stock levels narrow relative to demand, competition intensifies. That competition shows up in premiums. There is also a structural factor to consider. Silver is often produced as a byproduct of mining other metals, such as copper, lead, and zinc. This means silver supply is not always directly responsive to changes in silver prices. Even if silver demand rises sharply, production cannot instantly adjust unless base metal output increases. This supply rigidity can amplify the impact of declining inventories. From a financial standpoint, inventories function as a risk indicator. When stock levels are healthy, price volatility tends to remain contained because supply can meet unexpected demand surges. When inventories decline, volatility risk increases. Premiums expand as buyers attempt to secure allocation before conditions worsen. In such environments, the spot price alone may understate the true cost of immediate acquisition. Another important dimension is geographic distribution. Inventory may exist globally, but if it is not located where demand is concentrated, local premiums can spike. Transportation delays, export controls, and logistical bottlenecks can all contribute to regional dislocations. A premium of this magnitude suggests that local availability may be constrained relative to purchasing needs. Markets do not ignore inventory signals for long. When visible stocks tighten and premiums rise, attention shifts toward supply security and delivery capacity. Investors who monitor inventory trends alongside pricing data gain a clearer view of underlying market stress. In commodity finance, declining buffers often precede meaningful shifts in price behavior. Silver occupies a unique position in global markets because it is not purely an industrial commodity, nor is it purely a monetary asset. It sits at the intersection of both worlds. That dual identity becomes especially important during periods of financial uncertainty. When investors begin to question currency stability, capital controls, or broader macroeconomic conditions, tangible assets tend to regain attention. If physical silver is attracting demand beyond industrial consumption, that shift carries financial implications that go well beyond fabrication needs. The first question to consider is motivation. Why would investors prefer physical silver over paper exposure? Futures contracts and exchange-traded instruments offer liquidity and convenience. Physical metal, on the other hand, requires storage, insurance, and logistical handling. Choosing physical ownership suggests a preference for direct control and reduced counterparty exposure. That preference often strengthens when market participants perceive elevated systemic risk or volatility in financial assets. A rising premium can signal that buyers are not merely seeking price exposure but are seeking possession. In financial terms, this represents a movement from synthetic exposure toward asset-backed allocation. When that shift occurs at scale, it tightens circulating supply. Unlike futures contracts, which can be created and closed with relative ease, physical silver removed from the market reduces immediately available inventory. That dynamic can intensify price pressure if demand continues. Monetary demand for silver also tends to be more sentiment-driven and responsive to macro signals such as inflation expectations, currency weakness, or geopolitical tension. Even modest increases in investor allocation can influence premiums, particularly in already tight markets. Because silver's market size is smaller than that of gold, incremental capital flows can have proportionally larger effects. There is also a portfolio construction angle to consider. Institutional and high-net-worth investors often use precious metals as diversification tools. When correlations between traditional asset classes rise during stress periods, alternative stores of value become more attractive. If part of the premium reflects portfolio rebalancing into physical assets, it suggests caution within broader capital markets. Importantly, monetary demand does not need to dominate industrial consumption to influence pricing. Even a partial shift toward physical accumulation can amplify supply-demand imbalances. When financial buyers compete alongside manufacturers for the same physical metal, premiums can expand quickly. Understanding whether elevated premiums are driven purely by industrial necessity or partly by monetary hedging is critical for financial analysis. The presence of investment-driven physical demand introduces a layer of sensitivity to macroeconomic developments, potentially increasing volatility and altering traditional supply-demand equilibrium expectations. Markets are built on alignment. The quoted benchmark price is expected to reflect the balance between buyers and sellers across both financial and physical channels. But what happens when that alignment begins to drift? A persistent and wide gap between futures pricing and physical clearing prices forces the market to adjust. The only real question is how and when. When physical premiums rise sharply and remain elevated, they signal that the marginal buyer values immediate metal more than the benchmark suggests. That condition cannot persist indefinitely without consequences. Either supply conditions improve and premiums compress, or the benchmark price moves higher to close the gap. Financial markets are highly adaptive. Sustained arbitrage opportunities rarely survive for long without triggering capital flows that rebalance the system. If physical buyers consistently pay significantly above the global spot price, traders and intermediaries will attempt to exploit that spread. Metal may be redirected from lower premium regions to higher premium hubs. Futures contracts may be converted into delivery requests if profitable. Over time, this process can pressure exchange inventories and influence price behavior on the paper side of the market. In that sense, premiums act as a transmission mechanism between physical stress and financial repricing. The speed of adjustment depends on several variables. Inventory depth, logistical flexibility, financing costs, and policy constraints all influence how quickly supply can respond. If the premium reflects short-term bottlenecks, resolution may be relatively smooth. However, if it reflects structural tightness, such as sustained industrial demand growth or limited mine supply responsiveness, the repricing process can be more pronounced. From an investment perspective, this divergence is not just a technical detail, it affects risk assessment and strategy. If benchmark prices lag physical reality, volatility can increase once adjustment begins. Portfolio managers relying solely on futures curves may underestimate potential upside or downside moves driven by delivery pressures. Hedging strategies calibrated to historical spreads may require reassessment if premium behavior changes structurally. There is also a psychological component. Confidence in pricing mechanisms underpins participation. When market participants observe consistent discrepancies between quoted prices and transaction prices, attention intensifies. That scrutiny alone can influence positioning, open interest, and liquidity patterns. In financial markets, repricing is rarely announced in advance. It develops through incremental signals, tightening inventories, rising premiums, delivery requests, shifting trade flows. A sustained $9 premium represents one such signal. Whether it resolves through normalization or upward price adjustment depends on the durability of underlying demand and the flexibility of supply. Markets speak through price, but sometimes they speak louder through premiums. A $9 premium is not just a number. It is a message about supply, demand, and confidence in price discovery mechanisms. Whether this represents a temporary dislocation or the early stage of structural repricing will depend on how the coming months unfold. For investors and market observers, the lesson is clear. Watch the physical market closely, because when physical demand starts overriding paper pricing, it often marks the beginning of deeper shifts in the financial landscape. Stay analytical, stay disciplined, and always follow the real flow of supply and demand, not just the headline price.